Cloud Returns podcast covers all types of software investing, whether seed, venture capital, growth equity, private equity, debt, and even the public markets. Excited to have Joey Brookhart on the podcast today. And as is custom, we'll just let him describe himself and give him his background and introduce himself.
Yeah, perfect. Thanks so much, Matt. I come from a background of long-short investing. So I was an analyst for many years and then spun out or started my own fund, about 3 years ago in 2022. And a big focus throughout my career has been on software companies. So both infrastructure and application software with kind of a long short lens. So everything from kind of shorter term quarterly to more thematic and longer term theses, but also do a bit of my fund and previously did a lot of like growth consumer investing, public markets. So think smaller companies that are growing stores, restaurants at a pretty high clip or have some thematic background to them. So I've been a analyst for 5 years prior to that, and then a PM for close to 3 now. And from there, we started a company within my fund last year called AlphaRepo. And the big thing with AlphaRepo is I was looking to really track my Excel models, so understand my accuracy, how my numbers were moving over time, and comparing that to consensus, alt data sources, and kind of rolling that up to like a dashboard or CIO, PM type view to really understand, our differences, our divergences across our coverage, and understand, where IRRs, risk reward was at any time. And was really looking around and couldn't find, much that solved the problem. I was asking my friends at different shops how they did stuff, and it was either very manual, they had some very old system for it, but there wasn't anything that really sat in Excel and stayed out of the PM and analyst's way in a way, I wanted the tool to. I needed to be really custom to, very specific things like within software, like net new ARR, net new CRPO bookings, things like that. And I wanted to be able to track all those metrics. So we built that within my fund and then realized, hey, there's other people, could definitely use this. This solves a need in the market. So then I've been working, on AlphaRepo since early 2024 and the go-to-market there and some of our product work and just running that business. So we've grown that since then and really have made a big push to get into, a lot of long, short shops and your bigger long onlys. So that's kind of a rough background on me, but, kind of turned from, investing, public markets investing to solving a problem that I had and now running that business and selling to other public market investors.
Awesome. Perfect background for this. And also, I think for the audience to know, it's remarkably hard to get public equity investors to speak freely onto a podcast, just lots of compliance, firm reasons. And so to kind of like get a window and someone who's transparent on their process is a real opportunity for us. And we also know we have a lot of buy-side investors who listen. You guys should come on once in a while and share, but I'm glad we got Joey. So with that, when you're investing in software companies, what are your particular metrics? Not just what everyone does, but like, what do you orient to most?
Yeah, I think a lot of people's research processes start in the same place. They want to understand, read the filings. So 10Ks, the annual reports, S1s, maybe IPO up until for a lot of these newer SaaS companies, understand the story, the narrative over time. So going through their conference calls, quarterly transcripts, any things that's been published by management or as a primary piece of research or, primary document. What I then focus on is really what drives, you kind of want to distill in and synthesize to really what drives that company. How does the COO, CFO, CEO think about that business and how are they kind of driving it forward? I would say overall for software, the big ones, I'm looking at is net new ARR and net new ACV, those two hand in hand, depending on what's disclosed publicly. And really, things around sales efficiency and kind of that sales motion. So why is this company, why do they have some advantage in how they land, new logos, new ARR, or maybe, they have really, really great economics in how they expand, usage or product kind of upsell. That just makes for a good SaaS model. Because at the end of the day, with any public market company, what we're really looking for is free cash flow per share growth. And those two things driving top line effectively, and then how profitably you can drive top line, which for every software company is your sales motion, is really, and how you service that customer throughout that customer lifetime is really kind of the North Star. It's very depends on the company because, when you get into the specifics, an enterprise application software company, you're really going to focus on just net new ACV essentially for, those top, customers that, maybe 20% of customers make up 80% of revenue. And I want to spend a lot of my time on that versus, a consumption software company or infrastructure software company that bills on consumption. It's more of, hey, let's go look at average daily consumption revenue, and bookings and billings really doesn't, matter as much. The real, tough thing is within public markets, there's not many companies disclose ARR or like a real ARR number. So it's kind of backing into like a current bookings, CRPO bookings number or net new, billings, current billings number, to really figure this stuff out. But it's very company specific, but, North Star is really getting to how fast are we growing net new on the top line and how efficiently is our sales cycle and how we monetize that customer lifetime kind of returns of how that flows down to free cash flow ultimately.
And if you're willing, anything that you can share about like the next layer and further down of how you look at the sales efficiency, sales productivity, and effectively your sales modeling process?
Yeah, I mean, it's given the way these companies, the lack of disclosure, it's really difficult. And I think sometimes in management meetings, it's a little easier privately, to understand those things and get a little more color. But I'm really focused on what's the cost to land like a new logo, dollar of new logo ARR. What's the cost for a company to expand, to do that expansion motion. So if you see a company with 120% net dollar retention, for that 20%, what's that really cost? Is that, a really like high touch upsell where we have to attach a lot of new product? Or is that like a simple seat or usage based increase? And then two, what are you spending to retain, that customer? Is there really competitive space and low switching costs where, hey, we have to do a lot from a customer success and ongoing basis to keep this customer, or do you have a really sticky platform and, you might spend, 3 cents per dollar of ARR you're retaining in, your kind of best customers.
Beautiful. And a bit of a straw man here. Like, what are the metrics or focus areas that you find to be overrated?
Yeah, I think anything that's really backward looking or doesn't really tie to business, isn't a main driver of that business. So I think, one thing might be net dollar retention is really helpful when you look at some of those cohort charts people give in S1s or, the IPO prospectus. Really interesting to go in and kind of pixel count those graphs and really understand how those cohorts grow. Like, are the newer cohorts, do they not expand as much? And is it because they land higher, with a higher dollar amount? Or, is there something fundamental changing in that subsector? But it might be even something like, for a specific company, like net customer adds that quarter. So I can think of something in certain companies where, 80% of their revenue comes from their 100K plus customers, and that might only be, 10% of their customer base. You really don't look at net customer adds there because, it's not going to help you drive the model because their business isn't about acquiring number of new logos. It's, how do we really, grow the number of those, Global 2000, Fortune 500, logos. So it's really dependent on the business. Like I said, for consumption, do I really care about bookings or billings as much as like that day's adjusted consumption revenue type metric of how people are like currently using things? I remember in like the kind of optimization, SaaS days a few years ago, that was kind of a big, what's quarter over quarter, average days, average days in the quarter consumption look like for some of these companies. And so it's really dependent on, companies, but I think, there's a wide range there between application and infrastructure of what's important and what's less important.
And this will transition a bit into the next topic around positioning, but let's use that example of the company with, 10% of their customer base is above 100K, drives 80% of the revenue, right? And then it comes out that that company had a bit of an underperformance on number of ads, even though the majority of those ads are small businesses that don't add up a lot in revenue. So that's kind of like the setup. But the earnings day reaction, people like might over or under focus on that SMB ad story, right? And where that all gets is if you look at like the volatility in earnings day reactions for these software stocks, which can be a good thing from many perspectives, it's quite high, right? And that leads me to this question of like, where are we in the sophistication of the buy side in really interpreting the drivers as you've laid out, right? Where you understand certain of these things optically don't matter and the core drivers. And as people digest those earnings, like kind of on a 1 to 10 scale, how good is the buy side at quickly digesting?
Yeah, I think it's close to like an 8.5 or 9, actually. There are a lot of different market participants, even within public buy side, with very different timeframes and very different mandates. So someone who, and there's varying levels too, I think, of underlying SaaS and business model knowledge of there's definitely different people. You have software specialists, and I think they really understand how a software company operates, from the sales and the sales organization to the product organization, to management, and kind of understand, hey, what's the how does management drive this business, think about it, and that's how we think about it. Or and getting deep into what are they exposed to in terms of subsectors, or different themes that aren't maybe related to what the business does. They just sell into, a high percentage of their deals sells into this sector. I think with generalists, there's varying levels of both software knowledge and just business model knowledge, where, like you said, these are opportunities. When there is a big earnings move, I think there are certain names that I just remember this earnings season we're down 20 or 30%, and it's not uncommon for those same companies to be up or down another 20, 30 on the next print. But then you also have kind of, I wouldn't call it forced selling, but people have different supply and demand constraints, and they have to cover 40 software names, and they have a very tight risk mandate. And they're kind of, if the company doesn't hit a certain number of their bogey, or that kind of consensus bogey, that's why you see such outsized reactions, because not everyone can say, hey, this is a great buying opportunity. For some people, it is like that quarter is all that mattered.
Really, really good commentary. And we can kind of divide the next segment up into two things. And some of this is kind of like approaching this a little bit from like an outsider perspective, or you could just, take an independent view, right? That particularly in software, like everyone should manage expectations. That's a CFO's job. But in this sector, right, like the almost over dependence on beats, right? Where everything is just turned into, well, it's the magnitude of the beat. And, it's just a little bit ridiculous from an outsider's perspective. Like, do you have any thoughts on like whether companies have hamstrung themselves like with a good idea, but at this point, everything's really outside of the guidance, so it almost serves no purpose, and we're really relying on bogeys and positioning that a lot of people can't really see, and that ends up contributing to a lot of volatility. So I've totally mangled that question, but if you could elaborate a bit on your own viewpoints on like both management guidance and then how that interplays with buy side positioning.
Sure. I'll start with guidance and then get into positioning and bogeys, because it's definitely a long answer. But guidance, yeah, I think most people give a revenue guidance and an EBIT guidance, and maybe EPS, but there's very few that get into the actual SaaS metrics you would care about, like CRPO growth. And I think for revenue, these companies know it. Everyone knows that given a certain level of backlog, the backlog and the billings and bookings are all published, so it's not that hard to know before the quarter even begins what their revenue number is going to be from the following quarter, because it's not very dependent on new business. So the fact every software company beats by revenue by 4 or 5% or whatever the number is historically, and then they only beat by 3.5 this quarter, and that's why the stock sold off. I don't think it's because of that. I really do think it is. I mean, it's it's a tough topic, but yeah, the revenue side and the revenue beats isn't, I don't think, the main story and reason why. It's more of that bogey and positioning, where now there's something that sits outside the actual consensus or guidance numbers around what's the CRPO growth bogey, what's the positioning in the stock, the pods, fast money. There's kind of I'll go into a little more detail, but there's like these sell side salespeople will put out a survey where it's like you'll try to get an idea of, okay, what's positioning, with one being everyone's short and 10 being everyone's long. And they'll send out the same survey. Hey, what's your estimate for CRPO growth for this company? Company doesn't guide it, but and then they're going to publish, maybe a few of those metrics out to people the week before earnings. And a few things. The survey on positioning, I think, you'll get different stuff from different bank. Some of these larger funds have their own, can kind of back into positioning, and these factor models can as well. And everyone has a Z-score or a positioning score for something. That's important. When you see something that, is up, for 2 weeks in earnings, and, they come out and say, hey, it's an 8 or 9 in positioning. Cool. Like, we can see the price action that it's outperformed, the benchmark the last 2 weeks in earnings preview season. And, we can see from the bogeys, it's well above, street. So CRPO growth might be, the bogey might be 21%. The thing about bogeys is when I'm submitting that survey, if I'm long the stock, I'm going to submit a number as low as I can possibly think of. And if I want to be short that stock, I'm going to try to influence the survey and submit a number that's really high. So I have a friend who used to work, sell side research at one of the big shops, and he saw the actual survey results, and it's the inverse of a bell curve essentially. So people that are long, send in really low bogeys. People that are short send in really high bogeys, and I guess it all equals out. But there's that, and then the stock ends up more trading on that kind of positioning angle and where the actual numbers come in versus that CRPO bogey. And I think that's why you might have something that CRPO growth comes in at 20.5% versus 21, but position is an 8 out of 10. You're like, okay, well, they missed by 50 basis points. Why is the stock down 15%? It's because of that. It's just historically volatile sector. These software companies aren't exactly cheap. Most of them trade off revenue multiples. Now there's a little bit of a clearing event that people had this thesis on where CRPO would it hit that bogey or not, and it didn't. And now we get to go. Now we get to move on and play the next earnings.
Yeah, it's fascinating. Like just thinking through, like even like the sell side survey and the gamesmanship therein, and then how all of this nets out, and then what's the third derivative of that, right?
Right.
I'm sure someone's heard your response and is staffing someone junior to like, all right, how can we come up with the next level of the gamesmanship and infer the positioning of the positioning, like third derivative of all of this stuff, and further the arms race here. It's just fascinating to me.
It is funny. I know people build a lot of these sector dashboards, and it was one thing we really help with at AlphaRepo is if I want to get their CRPO at kind of the highest level, you can think of it as probably the best thing that approximate ARR for a lot of these companies that are public. And then you get to subscription, CRPO bookings, and then you might get to like a net new CRPO bookings, and people want to compile the year-over-year growth rate of net new CRPO bookings across 40 different software names they cover, and what that looks like, both historically, but then to their future numbers and what that looks like against consensus. So it's one thing we help with at AlphaRepo, and a big reason why I started it is because I do want to see across the entire industry what's that third derivative, that net new, the year-over-year growth rate of net new CRPO bookings across my coverage look like. And we make it very easy to pull that data out of Excel in a way that doesn't interfere with an analyst or PM's daily Excel workflow, but then compile that for people, in a PM seat or analyst seat to view it and actually, kind of make decisions, off of.
Realistically, just give us the elevator pitch for AlphaRepo, AlphaRepo.com, because I think there'll be a lot of learnings in simply like what you've built, why these features are there, that will tell you like kind of the state of the market. So what's the elevator pitch for AlphaRepo.com?
Sure. So at a high level, if you think of it, everyone in buy-side investing lives in an Excel model, or public markets investing. That's the source of truth on that name. Every piece of work you do in research in your doc file or OneNote file feeds into some sort of estimate in that model. And there's varying degrees of like model complexity. Some people, I just want to get the high level drivers right, the 2-3 things that really matter for this business, and put a reasonable multiple on it in 5 years and understand my risk reward. Like, when's a good time to buy? What's my margin of safety? And is this something to buy? Versus people that will model, just religiously, 1,000-line models, really detailed on every, quarter, trying to get in and find these like mechanical beats. So they might have pulled, I think a good recent one like I saw was, they're pulling a slide from, Google's GCP's like conference before this last earnings, and was trying to, understand the token revenue, because they'd given last year's number, it had grown 50x. And they were trying to throw this in the model, put like a token cost per token estimate on it. And they were showing like, 4.5% beat. I think GCP beat by, 4.7. So you have varying degrees of this, but the main story is Excel models are very siloed. You live in, Google model V25, but when you go to V26, you have no kind of view of how stuff changed from V25. So public markets are really about, revision, how you revised your numbers, but also keeping track of things like your IRRs, risk rewards, and things like that. What AlphaRepo does is essentially like this Excel plugin that, sits on top of Excel that'll read every line item and everything you want to track within your model, and it gives versioning and like history to it. So you can then send data, either view that revision data or send that data across the organization. So we kind of go from these very siloed and stale like Excel models to something, we kind of make it global and dynamic for public market investors. So understanding, we met with management, we're revising our numbers down, consensus is flat. If you think about that, with a team of 5 analysts that are covering 40 models each, you can't possibly see, across 200 Excel models as the PM, the information in those revisions that you care about, especially as you connect consensus data, alt data, and things like that. And then, so that's more of like what I'd call like our pod and shorter term type client. For our longer, kind of duration clients that are going to own something for 6 months to 5 years, it's really about building those sector sheets, CIO dashboards, and pulling that data out. That's really important too on a per model basis, and just understanding their entire book and their entire coverage of where's their best risk reward, where are we biggest, where are we furthest above street in data, and then 2, how do we share this or like data across the organization. So in the prior example of building that net new CRPO bookings dashboard for my entire 40 name coverage, I'd have to store everything on like SharePoint and then reference all those files individually, make sure my calendar matches were correct with all the different fiscal calendars. And it would probably crash my computer trying to reference 40 different Excel models. And I'd have to try to like figure out which one was the latest and always be referencing that. And we sit in your Excel, workflow today the way it is, with no templating, no changes, and allow you to do kind of anything you would want with those numbers outside of that model, in creating history and kind of attribution to it.
Wonderful. And what type, like, as always, like more people listen to these things, like looking for the next thing and effectively like want to know what they can buy and who should be buying this. Like, what's your ideal customer profile?
Yeah, we deal with a few. So there's some things where they've attempted to do this before. Right? And this is probably your top 20, 50 buy-side public equity firms. And it sits in like, it's a separate template page today. And it takes, a lot of time out of the analyst workflow, or back office is updating these numbers manually to send them to the CIO and then to sync it all back into the CIO's dashboard. It takes a lot of time, it's cumbersome, and it doesn't cover the entirety of the Excel model because it has to fit into a template. In those kind of conversations, we work with the tech team, usually a CTO or the head of data, head of fundamental equities engineering, for those type of conversations where we're ripping something out or replacing something that was really cumbersome before. There are other kind of line of businesses, we just go straight to the portfolio managers or CIOs, and they can get off and running out of the box, really quickly within a few minutes, and they can get everything in the web app and dashboarding and the Excel plugin very quickly. And it's, so if you have problems that you want to see your revisions, you want to see how accurate you are, you want to see how accurate your analysts are at different metrics. They're really good at, mid-cap internet incremental margins, but they're not so good at, MAU type metrics and large cap internet, things like that. And even stitching together these giant sector sheets. So I want to see my divergence against, visible alpha consensus across all my same source sales metrics for all of my restaurant coverage. And I just want to build this so it's always live. And that's where we go to the PM and kind of work with, understand their workflows. There's a wide range of what we do, but it's kind of understanding that what resonates with them, what they're doing today manually. That's a real pain point for them. And, you wouldn't expect, but maybe one of these, PMs at a large shop might be even spending, 8 hours a month, doing something manually, and their analysts are even spending more that then we're then freeing up where they could do actual fundamental research.
And can you give any commentary on how, like, on the public company side, the IR side, the CFO side, their sophistication in their forecasting? I know it's a little bit outside in, but compared to this buy side sophistication.
Right. Yeah, I think IR, there's a few things. And I've read this somewhere, I forget where. There's someone that says like Morgan Stanley does a pre-IPO kind of teaching for CFOs on guiding. So yeah, they just always guide low because companies that always beat guidance go up. So I don't think anyone expects any software company that comes public to start guiding, more realistically, like numbers they actually think, they're going to hit by a small margin. The one thing I'd say on IR is they're either a little too good, so they know that the key debates coming into that call, and it's all scripted for management, pre-Q and it's like that after, might go through a few years and it's always a little too on point to every little debate and questions answered, or there's too little. So it's really impossible to understand from public filings or even talking to them, the key kind of drivers that they view the business on, like in-market exposure, if you're really trying to dig deep into those kind of answers. But I don't think you're ever going to change the guidance philosophy for many of these companies. The one thing I would say is, especially given some of the SaaS sell-off recently and what I remember from 22 on is, free cash flow per share is the North metric. And if you can reliably grow that, it's always good to make the right investments long-term for the business, when those are needed. But really focusing around free cash flow per share and making sure you're growing that and, you're not, if you get too bloated, that there's the right long-term focus on that is, I think, the biggest thing, because you're not going to change guidance philosophies. There's varying degrees of how forthcoming certain IR teams are willing to be with information. I don't think, that's either a DNA thing or, very intentional to either be very forthcoming or, ahead of the ball versus, more closed off and the public comments are all we're going to comment on. But just making sure, I think investors know there's a strong focus on free cash flow per share and growing the business sustainably over the long term. Because I think right now in public markets, or at least the stuff I follow after some of these sell-offs the last few days, these are like, a lot of these are very good businesses. They're very attractive business models. And, they just need the right, people. It's tough to bring generalists into this to get excited about software if, revenue growth is slowing and profitability isn't, is kind of wavering. You're not growing free cash flow per share at a higher clip than revenue, even though revenue is decelerated, 20 or 30 points.
Yeah. And two things there. One, like for a number of the IR folks or CFO folks listening, they're like, well, we don't have any free cash flow. So that's a challenge. And then two, like kind of from the generalist side or just, being a valuation aware investor, like you can look at some of these price targets and it's, 34 times 2032 free cash flow discounted back to today. And you're like, 34 times and way out. That's a lot. That's a pretty big multiple, particularly for how durable these businesses might be, like project management software or observability software or so many forms of infrastructure. Like the amount of change they go through every 3 years, 5 years, that 2034 might as well be 2070 in a lot of scenarios, and you're still paying 34 times free cash flow to get a 12% IRR and you're going to deal with an incredible amount of volatility every damn quarter. It can be a challenge to dip your toe into some of this.
Yeah, and it is. And I am sympathetic to the IR people and CFO that have to deal with the varying degrees of extremely short-term modeling questions that they hear during conference and callback season. That probably doesn't sound too relevant to the business for them, but given the business models of some of these larger funds that they just have to, and who pays the commissions for these conferences, it's they just have to answer those things. But also, there's a wide range of businesses and there's a wide range of, even within software, I think there's a lot of terminal value questions right now, but it's there's a wide range of companies out there people can be investing in, and unless you've got a really good story of why you are investing today, not growing free cash flow or don't have free cash flow to really kind of understand and get right about that. The days of everything trading above 15 times, 20 times revenue are over for a while.
Yeah. Look, this has been great. I love the level of detail and sophistication we've gotten into, and I think that would be great for a lot of people. And then, podcasts in many ways are for learners, right? And for someone who's in college or is an investment banking analyst or a junior equity research associate and wants to get to the buy side, what are some advice you'd give them both to break in and then B, hit the ground running and really be a great analyst? Like, what are some advice you have?
Yeah, the biggest thing is getting at bats. I don't think anyone's a good analyst their first year to 18 months. To answer the last part of the question, just get at bats pitching, like asking people for feedback. And people are very open. If you send 100 people your idea on something that maybe they own in their 13F, I'm sure you'll get a few, if not a few, maybe 10 responses, and people will be willing to talk. Like, just get at bats and try to talk to people and people in the seat to understand the line of questioning they ask, what they're focused on, especially if they own the name. Most people aren't going to have a massive ego talking to a college kid and try to show you all they know on it. They're going to try to guide you through it. But the biggest thing, and I think this is more I'm very thankful I came about before the ChatGPT era of summary and going through this data. But if it's really a name, within your coverage that you're going to focus on, start with the primary docs and go religiously, through the last few 10Ks, maybe the S1, go through the last, maybe 5 Q4 calls and the last 8 quarterly conference calls. Get an idea of, the business. How do they talk about the business over time? What questions are people answering? What's that narrative? Go through the conference transcripts of how they talk, on kind of a broader basis to a wider audience on these things. Like, really focus on those primary documents, then go to some of the secondary, documents like sell-side research, maybe some, primers on, that subsector, going into the competitor, things like that, and really writing down, hey, what are the drive, like, what are the few, key drivers of this business? What are the 3 things that really, metrics that matter, how they think about the business, where's growth going to come from? Like, do I have a view on, just the overall industry growth, subsector growth, this company specifically, what really matters? What are the big questions that, like, we need to answer for this, not for this to be like a good investment, but like for this to be, is this a good company? Like, what do I have to answer? Like, what are the biggest risks to them, the way they run the business today? Like, what are the biggest risks in their like own planning for the next 5 years? Or like, is there, I think in software, especially in small cap, you can deal with something that's 300 million of ARR, and there might be something that's 15 million of ARR that, like, we really need to keep an eye out on. So understanding all that primary research first, and then go build the model. Like, understand, how do I flex different assumptions and net new ARR growth, and how does that flow through? Am I thinking, this is software specific, if you're building that sales and marketing off of net new, or if you're building, sales and marketing first to drive net new, how many people do they need to actually hire? And I think this is where a lot of people, especially Buyside, it helps to really understand the SaaS business model. Good examples, Shopify, I think an analyst at a different firm came to me like a few, late last year. He's like, I've noticed Shopify has a ton of job applications up for enterprise, sales reps. And they have like something like 20 up, which is like, he's like, I think they're really going to beat on GMV, as they bring over, these enterprise accounts. And you kind of have to walk them through, okay, they've got 20 jobs, they've got 20 positions up today. What's the period of the hiring them? What's their ramp period after that to when they start actually going after deals? What's the time to close deals, and how are they going to compete against Salesforce and Adobe on those deals? And do they have the right motion or right people to actually win that and run this organization? Okay, cool. We're probably 5 quarters past today now from when they hire all these people. Now what's their ramp time of moving over to Shopify and actually ramping, the GMV sold on, Shopify platforms? So I think if, you need to like have a little bit of an operator's mind to be a really successful buy-side analyst and think how the company thinks. But you need to do the primary work first to really answer, like, and come up with a list of questions you need to answer on what drives that business, what are the risks, and then you can go into the model and say, okay, this is how I think the mechanics of the business work. What's a good price to pay for this business? What things would invalidate, my thesis that I've priorly, my prior thesis, and then two, if that happens, or then how do we think about returns from here? Maybe they keep beating your estimates. It's going really well. You underwrote it at 12% IRR. It's returned 20% for the last year. AlphaRepo helps you understand, hey, that's because revenue beat consensus by 8% and they beat our revenue number by 5%. But we got the multiple a little bit wrong. But how do we go from here? So as we roll our price target forward, how are you keeping track of that and having some process and some system around that? But that's the main thing. Do really good primary work, synthesize it, ask good questions, build the model, understand risk reward, and then it's ultimately just do that as many times as you can and do solid work around that, and then get feedback and just take as many at-bats as you can.
So that's an amazing answer, and it might vary by role, but you included AI, and it's fascinating to think about, when you think about filings or digesting earnings or all of the other dimensions AI is going to be capable of or is already capable of. And so the question there is, AI for the buy side, opportunity, threat, or neutral?
I think it's a massive opportunity, actually. I know adoption's been rather slow, especially at some of the firms we talk to that are larger and have very valid security concerns about those. But there seems to be a turning point of, hey, let's figure out how we're actually going to harness this, because I cover 40 software companies, and then I have a pretty wide net within consumer where I just opportunistically look at things. And I can probably go summarize every restaurant earnings. If I'm really focused on a few growth restaurant stocks that are on my watch list, I can go summarize everything to get me, hey, pull out all the cost bucket information from these 30 restaurant names that I've reported. I was never going to be able, no analyst is really going to be able to do that even that quickly. It's not a great use of their time either, especially if it's not in core coverage. But I can go understand, hey, how did those cost buckets, what are people seeing right now? Oh, it's going to summarize the breakfast places see this in eggs. Texas Roadhouse looks at risks because they're kind of more middle of the road, and beef prices have gone up 8%, and this has been mentioned in XYZ transcript as well. So I think it's a big unlock in terms of what people can do, and kind of use it as a research tool. I haven't seen anything yet, and that's a massive, is going to make the analysts obsolete. Maybe analyst hiring slows a ton in the next 10 years, but you're still going to need humans in the seat. They're going to have to drive that model. They're going to have to do the work. They're going to have to make decisions. There's a lot of human judgment still involved. And the big part in financial services that I think people were worried about that's starting to get solved through some of these MCP things like Anthropic's doing with people like DeLuca, and bringing in, I think, S&P Global and a few other people, is actually getting in the right data to actually the true data, because these things for a while would hallucinate it, just make up numbers on whatever Salesforce's revenue was, and they were really difficult to use for things that were outside of bringing together a ton of transcripts or podcasts, summarizing or synthesizing them for you.
Yeah, that's a wonderful answer, and I tend to agree with you in so many of those things. And you step back a bit, and the sophistication of all of these things. Like when I think about what an equity research report looked like, and kind of my earliest exposure to them was 2002, right? And also the work we did in our investment banking group, how we maintained comps, right? It was pre-cap IQ, and it was, and all of these things. And now, everything you're discussing right now. And so layer in AI and the sophistication of these firms and the analysts and PMs involved, it's just going to go to a whole nother level. And what was a 80-page deck is now going to be equivalent of 750, but it will also have Q&A built in, and 5 times the amount of data processed, and all of these things that I think you fundamentally can't get rid of a smart, motivated human from this. And then when you also think about the dollars involved, right? You're putting $150 million trade on.
Right.
like why, like just thinking as a business person or anything, like how can you let a machine kind of do that unsupervised, just for
Yeah,
fiduciary duty even?
right. And I think in like, yeah, if you think of like investment banking or equity research more as like sales roles, yeah, I think the hesitation in public markets like Buyside is really, it's not a sales role. It's a you make money or lose money role.
Yeah.
And the risk that something, the more you automate and the more you trust it, I think there is that trust issue still of, I mean, I know some tools that aren't AI tools that still people don't, trust fully, even though they might have 99.999% data accuracy because of the process of, I want my analysts entering these numbers manually and things like that, because there's too much at stake for them. Essentially, my job's at stake, my bonus, whether I make money, lose money at the end of the day is, too important. So I'm sure probably I'm not thinking big enough yet, but I'm sure like we'll continue to supplement this buy side workflow process with different AI tools over time. But like we've been on a few of these AI tools for hedge fund lists and AlphaRepo, and I think bar a few, most of them are just chat GPT wrappers on filings and public, publicly available data. But I think we'll get more and more of these kind of either custom workflows or deeper for buy side finance workflows that are more AI heavy and built to actually fit in. The other thing I'd say with AI is it makes the services side for kind of how we think about like the business at AlphaRepo, it makes that side a lot easier. And we definitely like do a lot more custom type onboarding and services kind of division here because we're fitting stuff to process. We want to make sure our tool fits in with their process and how they want to view that data. Our bread and butter is the extraction out of Excel and then throwing data back into Excel, whether that's from a different model or from an external API. That really fits into the analyst process really well. But we are kind of, how we do the services side, AI really does improve. And I think there'll be a lot of very custom type, and maybe that's agentic, workflows that really solve some of these smaller and very company specific and fund specific, workflows, because every fund is so different and a lot of these templated solutions just don't work.
Yeah, doing some work on our side, quantitative development, everything. It is amazing, like what is now eligible and open to so many people, and it's going to be exciting to see all this unfold. And I guess we'll just wrap it up with, again, I've noticed, people listen to these shows to learn like the latest and greatest, just like the final mini elevator pitch at AlphaRepo, how to find you on socials, how to work with you, just something for people to hang their interest on.
Yeah. Yeah. So AlphaRepo, if you think of any issue you have in your current Excel process, whether you're a buy side firm or even, we can work with anything with a date row, honestly, that you have where you're trying to capture point in time Excel data and then use it for any comparative purposes to other data sets or to itself, or sync data in and out. That's what we do. And we do it in a very seamless and way where we fit in. You don't know, you barely know we're there. And there's nothing you have to change about your current workflow for us to fit in. Best way to find me is, we do some LinkedIn and Twitter posting. So it's Joseph Brookhart on LinkedIn. AlphaRepo.com is our website. And then I have a formerly, anonymous Twitter account at SasquatchC on Twitter. But I would say that's mostly used for product marketing at this point.
And I will credit that, by the way, through our analyst business, we interact with a lot of CMOs and product marketing folks, and we cover those sectors. And Joey, I have to say, you are one of the best product marketers I've seen in the last few years. Like if you guys go follow his LinkedIn or his Twitter, right, he does a great job of what I like about it too. It's true demand gen that you have. Like you always get someone to a demo page or a screenshot. It's not brand. It's like pure product marketing demand gen. And I love it. So if you wanted to, you could go to any of these software companies and be a top tier product marketer. So,
well, thank you. I really appreciate that, Matt. I know we've discussed in more detail before, but it's I don't know if we call it vibe marketing or, I mean, we try to keep it very solution specific. But I think you'll see even more of that for some of these different ICPs, whether that's CTO or PM at the fund. That's we can break down to we kind of have 5 or 6 different solutions we actually sell, value props. So I think you'll see even more of that over the next month or two.
Well, I love it. It's, as I say, it's all gas, no brakes marketing, right? Like you get the Calendly page in there, right? There's no like
There's always a call
sequence.
to schedule. Yeah.
It's get to the Calendly. Like I love it. I think more software companies need that. I think we would see better sales and marketing metrics. There would be a lot less, wasted leads or low quality leads. Like because the only people who are clicking on your Calendly page, like get it and want to talk to you. And so I think maybe for any of the operators or some of the private equity people who have some control over their portfolio, go look at Joey's LinkedIn and think about how your portfolio should be doing that, or your own company, like all gas, no brakes, product marketing. So I think we'll close out on a lighthearted note there. And look, I appreciate all of the advanced commentary you've brought to the table here, and this has been fun. And everyone, as always, the show notes will have everything. If you need to find anything or anything about Joey, it will all be there in the show notes. So thanks, Joey, and see you soon.
Yeah, awesome, Matt. Thank you so much for having me.